And begin the show with the market voice. Srinivas Rao Ravuri, he's the CIO of PGIM India Mutual Fund, joins us right now on the show. Srinivas, good having you. Thanks so much for joining in. Good to have you on Bloomberg Quint. Welcome.
Thank you. Thank you.
Wondering what's your stance right now? The earnings season thus far hasn't looked all that sketchy as what people anticipated. Could it be a factor of the first few numbers looking good and then the skeletons start tumbling out?
Yeah, typically the first set of numbers are good, and in fact the second half, this 45-day period, in the second half is when you see, more companies declaring relatively weak numbers. So I think we're seeing the early numbers which are reasonably decent, but market is still worried about what will happen for the entire season. I think overall expectation is that numbers will be very, very weak. I think the expectations are low, and in that context, even if you see a marginal improvement in some companies, I think market will look at it very positively.
Are you positioning yourself for that? I mean, your overall equity AUM, let's start off with that. I mean, what would that equity AUM be and how is it positioned right now?
See, at the end of last month, our PGIM India Mutual Fund equity AUM is about 1,400 crores.
Okay.
So our stance is that we will see a gradual recovery in economy. So yes, it's a fact that economy is going through tough times. It's a fact that corporate earnings are weaker than what one was expecting at the start of the year. But I think we are closer to bottom, and we will see actually things getting better from here onwards. So when we are investing in equities, we can't be having a quarter view. We have a 1 to 2 years view. When you see that, I think we'll see things getting better for both economy and markets.
What would you do in terms of rebalancing of portfolios? Obviously, we've been seeing if you had a portfolio which you built in with some weightage to large caps, some weightage to mid caps. Large caps have clearly outperformed the mid caps right now. Yeah. Would you still keep adding more large caps, or would you try to play beta a bit?
Sure, I think very interesting point. I think if you see last 1 year, Nifty has delivered about 13% returns, but Nifty small cap is down 13%. And 2 years it is down about 30%, Nifty small cap, whereas Nifty is up about 14%. So over last 1 year, our funds were essentially in high quality large cap sectors. But I would say over the last few weeks, I'm actually reducing exposure to large caps and adding small and mid caps. The reason is twofold. One, we've seen a very sharp correction in stock prices in this mid and small cap. And B, I think, when you are worried, you tend to be more on large cap liquid names. I think, and that's the reason why, many stocks are trading at 60p, 80p. I think that is not sustainable. B, the moment you see earnings recovery in this mid and small cap, and when you see a little bit of comfort that, we will see things getting better, and these stocks are trading at a single-digit P. So I think the risk return is definitely in favor of mid and small cap. I'm not saying that one should go overboard on mid and small cap right away, but I think compared to our positioning where we are massively overweight in large cap, I think from there, we're gradually increasing our exposure to mid and small caps.
Interestingly, in a conversation with N. Jayakumar this morning, he said that I'd rather be hunting when nobody is present than be present where everyone's hunting. So, to just pick and choose the smaller names which have been ignored up until now, that's probably the strategy that many have started to see.
Correct. In fact, last 6 months have been so bad for mid and small caps. Even on a very thin volume, we've seen stocks correcting. So we've actually developed screens where we are saying that let's look at stocks that have positive cash flows. Let's look at stocks that have corrected, let's say 40%.
Alongside positive cash flows?
Yes.
Those are a few.
Correct. I'm saying we have screens saying that A, I need positive cash flows. B, I need positive outlook on business and earnings. C, I want reasonable comfort on management. And D, if stock is corrected meaningfully, and that's an opportunity for me.
So if all those stocks check on those parameters,
correct,
you're going ahead and buying
exactly,
them.
Yeah.
Okay, let's talk about the space which has been in focus, rather one stock. I'm not asking for your stock view on Infosys,
Yeah.
but I was just checking. I think a lot of your funds do have weightage to this stock. Just tell us, what have you made out of the entire saga which is unfolded again with regard to corporate governance? In fact, today exchanges have sought clarification from the company asking why wasn't any voluntary disclosure made if there was some sort of receipt of whistleblower complaint. What have you made of that? In case, of course, the allegations are not proven right, if that happened, how serious can that be?
Yeah, first, I don't want to comment on individual stock, but at the same time, let me highlight. I think the point here is and certain issues have been raised by a whistleblower. And if you actually see objectively what is the financial implication of those issues, what as a fund manager, as an analyst, what I have to look at? I have to look at certain things are happening, what is the impact of this on earnings and what it indicates about the quality of management. If you see the issues mentioned there, according to me, they are trivial versus the stock reaction that we've seen. I think for a variety of reasons, I think this clearly highlights the panic or the fear in the market overall. I mean, you see the financial impact of issues mentioned. It is virtually nothing. I'm saying it's single basis point impact on earnings. But companies like what you mentioned are stand for a very high in terms of gold standard for governance. So when you hear even small things there, I think market tends to get worried and people have reacted the way they have reacted. It's a fact that the co-founder is still the chairman of the company and he's going to stay the company. So I am not so worried about what we've seen there. So yes, there are some issues, but I think when you see the overall picture, I think the impact, possible impact, if all of them are proved to be right also, I'm saying the impact on earnings is negligible.
Actually, I just want to follow up on that because yesterday we were talking to Sudhin Apte and he said that it is not unusual for companies to get deals at lesser margins because the environment is such right now. So it's not just a problem with Infosys, it's probably a problem with the other companies as well. So in that matter, it may not raise too many alarm bells, but just the fact that it wasn't reported the way it was supposed to be reported.
And could that bring down valuation multiples?
Yeah. No, I think, you see, when you are pitching for large deals, in most cases, accountants may not know the full picture. When a CEO is pitching for a large deal, you are not just looking at the numbers as they are seen here. You are saying that, okay, by winning this deal, what are the strategic benefits that I'll have? What are the levers I have on cost front? And what else can I do? How do I leverage this? I think we need to keep all those things in matter, not just saying that, okay, this deal, as of today, Excel is telling me I'm not making money whether I bid for it or not. I don't think that's a way to look at it. It's a very narrow way of looking at things.
Okay, we'll have to wait and watch with regard to what the investigations now throw up by the audit committee. But also talk to us about the banking space. Most of the bigger private banks have come out with the numbers, I believe, barring ICICI Bank. What have you made of the numbers? Has the asset quality trends improved according to you? Has the NPA cycle bottomed out? Besides RBL Bank, which is once again thrown up a surprise, though it was more or less expected post the commentary after the first quarter.
Yeah, I think two things. First, only private banks have declared numbers. We've seen more challenges in PSU banks. Yes. They are yet to declare numbers. But I think it's a fact that, when you mentioned about NPA cycle, I think that is clearly peaked. There are no doubt about it. It's not just me. You talk to anybody, any expert. We've actually peaked last year. And we will see gradual improvement. If someone was expecting a stronger improvement in NPA cycles, given the new sectors, whether it is agri, whether it is MSME, I think the recovery is lower than what one was expecting, but the trend is clearly, NPA cycle has peaked and we will see improvement.
That's, but obviously that is also a function of the government stepping in and saying you cannot categorize any MSME loans as non-performing assets for till next year, March. So it in a way is pushing things back a bit.
Yeah, see, the fact of the matter is economy is going through a challenging period, and which in turn means certain businesses will be under pressure, and which in turn will see this NPAs being higher. So we are witnessing that, but everything is relative. I'm saying versus what we saw last year versus last year, where are we? I think the direction is clearly downward. We've seen, I think last 2-3 years, we've seen some mega accounts turning NPA. I'm saying compared to that, now we are seeing smaller problems. And that is where when you look at the overall loan book, we are saying that that cycle is actually turned.
Okay. One final question then. Within the highly valued space, where is it that you have the comfort because of either earnings visibility or the belief that valuations will not falter that you are comfortable keeping large positioning on?
So I would say, no, I don't have comfort on any of these so-called high quality but high PE stocks.
Okay.
But as a fund managers, we have to be aware of the weights in benchmarks.
Sure.
So I think you will see positioning saying that if something is at 10%, even if I'm not comfortable, you tend to have 5-6%. You have to respect the benchmark.
Yeah, which is fine. So I'm
Yeah.
not asking about your. Okay, I'm just asking you, where would you be comfortable keeping these positions on? If you had a choice of not sticking to, would you scale some of the money off from? I'm not asking you to name stocks, but I'm just using them as reference points.
Yeah.
The HDFC Bank, Bajaj Finance, Kotak Banks of the world. Would you scale positions back from some of these names?
So if you see our portfolios, actually I've kind of reduced exposure to the high quality but high PE stocks.
High PE stocks.
And increased exposure to sectors that I'm more comfortable, like chemicals, pharma, utilities.
Okay.
Many of these utilities are trading at 5% dividend yield.
Yes.
Okay.
And traditionally, those have done really well. Yeah. So.
But last 10 years have been bad.
Let's see. I mean, I remember RECs and of the world, whenever they hit those 5%, 6% dividend yield, they tended to bounce back from there.
Yeah. So
Actually, just one last question, and
Sure.
then on these dividend yield, divestment stocks that
Yeah.
we've been talking about, how are you going to approach that angle?
So, unfortunately, government, the largest shareholder, has not acted the way it should have. Largest shareholder should act in these companies, in the sense regular OFS irrespective of stock price. But now, the moment you say that I will actually privatize, the real value need to be unlocked. I think that's what gives me a lot of comfort. And utilities, I'm saying, these utilities have a contract, signed contract for next 20 years revenues.
Yeah, so there's earnings visibility for sure. Okay.
Yeah.
Well, we wish you all the best. Thank you so much, Srinivas, for joining in
Thank
today.
you for having
Good
me
having
here.
you on Bloomberg Quint.
Great to see you.